Trading the tariff tsunami. When tariffs spike, volatility isn't a bug, it's the trade setup. Good morning, traders, and welcome back to the Sensa Edge. This is your host, Zoheb, where we don't just react to the news, we turn into actionable edge. Today's or yesterday's headline after market hours has been the Liberation Day, reciprocal tariffs. And no, that's not a movie title, is it? It's the White House new tariff metrics targeting over 60 countries. So, what does that mean for us as traders? Let's break it down, look at the impact, and more importantly, how do we profit from it? Again, high level macro impact breakdown. The new tariff are hitting across multiple industry: autos, technology, retail, manufacturing. Countries like China, Vietnam, and India, and many others like 60 countries just got slammed with a huge trade friction, especially these top 3 or 4 countries where the US companies relies on parts, chips, and labor from this region will face rising cost. That means tighter margins, lower EPS, and the stock weakness. So what should be on your radar? So watch for this particular tickers, which is on the auto sector: Ford, Tesla, and General Motors, which heavily relies on China, Vietnam, and Taiwan. Apple, Nvidia, and AMD, which is the tech titans with global supply chain. This will certainly have an impact. And Costco, Walmart, and Nike, consumer giants exposed to import cost. If pressures mount, we could see a short-term pullback or a larger rotation out of these names into value or domestic plays. Strategy playbook. So this is where the sensor market comes in. Let me bring up my screen and then let's jump into deeper. So as I'm seeing in the sensor market here, and this is all the strategies you can trade. Sensor market, you go to option strategies. There are 100 plus pre-built option strategies. You can certainly look into as many strategies as possible. I'm just picked up put vertical spread. This will be a great bearish strategy if you're expecting a continued weakness, but want a limited risk. In this case, what I did is Tesla shooting for 30 days expiration date, buying a put at 285 and selling a put at $260 put. So anything less than 273, if the Tesla drops, is where I can see some profit margin here. The debit code currently somewhere around $11, which is multiplied by 100. The debit to get in is $1,100, but the profit margin could be higher, 1,398. The break even, anything below 273 is where you will see some profit margin. The second strategy, let's bring this one up here, and Apple, which is nothing but the diagonal put spread. Again, perfect if you're bearish short term but want theta to work for you. It drops modestly if towards the 215 strike price. Again, I've selected this 215 strike price. Again, feel free to kind of like play around with this particular strike price. All you're shooting is like you are selling this particular put and buying a put at a later date. This I've selected May 9th and this on May 16th. In this particular thing, if the trade stays around 215, which is around May 9th, so the short put expires worthless. The retains longer term bearish exposure via the $230 put. Couple of other strategies which could be really good. Again, I picked up the Costco here, Iron Condor. Again, shooting 30 days out. I've spread across the particular strike here, buying the 900 put, selling the 940 put, and selling the 980 call, and buying the $1,000 call here. Here, anything in between $924, if the kind of like fluctuates between 924 and 995 is where the profit margin lies. But if you see, I'm like I place in such a way that I can adjust this particular strike so I can benefit from a little bit of slight movement within the 30-day period. This is an Iron Condor, and similarly, I picked up the Walmart, which is Iron Butterfly. Again, 30-day out. I can play around with any of this particular strike price. I can adjust this. If anything lies between slowly, I can make a good profit here. If I'm still kind of a neutral to bearish in this particular case, the net credit, I'll get $372 because in this particular strike, 77 put, buying, selling, and $90 put and $90 call for the sell position, and buying at $94 call positions. So anywhere between $86 and $93, if it rallies in between this could be a good strategy as well. Again, don't forget unusual options flow. If we go into here, take a look into this particular particular thing, how the market trends, who are the big players who's going to be buying any of those calls and shorts, you can go into the filter here. You can like filter yourself to any particular company. You can do a ticker type. You can like select what are the big premium orders which could be flowing in. This could be one of a good tool for you to kind of like look into and then dive into deeper in the Sensa market. Again, bringing back myself here. In short, tariff drama equal to volatility, which is equal to opportunity. Don't trade the headlines, trade the reaction, the flow, and the setup. Use strategies that respect your capital, embrace uncertainty, and lean into the tools to stay ahead. That's all for today's episode on the Sensa Edge. Subscribe, share, and remember, when the market yells, smart money listens and then trades. Thank you all for watching.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.